with the first one. First one I would like to look at is Palantir because that's one that I could afford, right? So I always like to go with the one that I could afford first. So Palantir is perfect today because it's what? It's not doing well today. So I would just like to get started with the cash secure put on Palantir. Nothing crazy, just one. We just want to get it on the books, guys. Want to get it on the books, and I already did 50 of these in the other account, so I already know that this is where I want to be, and I want to be right here. I want to be right here. Yeah, it's a 34 delta. It's a little bit aggressive, but I'll manage it. Like I will manage it. So that's where I want to be with Palantir. So we're going to go right here, one contract, review order, and call it good. So there's that. So that's the first thing I wanted to do. I already studied everything on Palantir. So I already did all the homework on the front end, and I already sold 50 of those cash secured puts on the other portfolio before I got on this stream. So this was a no-brainer play for me. Like this was already premeditated, if you will. So you guys will see that Palantir is already part of the plan. So we've already got 2 of the 4 horses rocking and rolling, right? Palantir is, we've opened the gate on Palantir and we'll see what happens. We want to start making money on Palantir. Now, the beautiful thing about this strategy for me now is now I look at the scoreboard and I see 2 investments and I only see 1 trade. NEO's the trade that's gone bad. Hopefully we'll be able to remedy that trade, get out of it unscathed, and we didn't lose any money. Hopefully we even make a little bit of money. But the only thing that I want to see with this portfolio is nothing but investments. Why is that important, guys? This is a real big teaching moment for you guys and for me. Is because whenever times go bad and stocks go down, if you have investments, meaning you have companies that you're proud to have in your portfolio for the long term, for the next 3 to 5 years, it doesn't matter if you're bag holding a little bit. It doesn't bother you because you don't have any intention of selling these companies anytime soon. Now, it's a little bit riskier whenever you're buying leaps and you're running the poor man cover call campaign because you don't have the luxury of time, right? Time's not on your side. Every ticking day is going against you via time decay. We're not collectors of theta on that side of the equation because we can't afford to be. So there's gimmies and gotchas with everything. So we're going to have a little bit of urgency on the poor man covered call side for the stocks to perform. But on the regular cash secured put covered call campaign, the regular wheel campaign, if you will, we don't have as much urgency with SoFi and Palantir because we already long those stocks mentally. And we're obviously already long those stocks, even physically here with SoFi, because we already own the 500 shares. We've already bought the 5 leaps, and we've already got a crap load of cash secured puts as well. I'll show these to you here in a second. I haven't gone through the open positions. I wanted to make sure that I put this Palantir trade on real quick before I lost it. So let's get into it real quick. Let me show the State of the Union. I'm going to go through the open trades, and then I'm going to see if I can buy a leaps at least on PayPal right now if I can't afford one on Tesla. So let me look at the money. Let's look at the money to see if we can afford what we can afford. So right now it says margin is currently enabled for the account and is available for use. So that means that we haven't even tapped into margin. So that part's really, really good. So the account is very healthy right now. So we have individual cash of $18,633.67. The margin available to us, the margin total is 33,000. Options collateral is 12 grand. So let's look at what do we have. We have the SoFi 850 cash secured put expiring next Friday. So that one's obviously going to be assigned to us unless I'm able to roll it, but I don't even know that I'm going to look at doing that. Then we got the NEO 650 covered calls. Those are obviously out of the money. We have the Palantir 2350 cash secured put that we just sold right now that we're about even on. Then we got the SoFi $8 covered calls that we're down a little bit on. Then we've got NEO $5 puts that we're down on. So this pretty much caps out our position on NEO. So that's what's going on with NEO. So we'll essentially be bag holding 500 shares, and we're going to have to be selling very aggressive covered calls, probably in the 550 range, until we can get out from under Neo so we can free up that capital, because that capital is going to be very important, because I'm probably going to need that money to buy the leaps on Tesla, because I don't know if I'm going to have enough money to do all of that right here, right now. We'll see. Hopefully I do. But if I don't, well, then we know that Neo is holding up that program. And then I sold more cash secured puts on SoFi yesterday. So yesterday, I already had 5 cash secured puts on SoFi at 7. And I went ahead and I sold 5 more. So you guys can see here that I collected an additional $85 or $17 a contract for 412. So I wanted to put some of that money to work. And the best position that I could find was my highest conviction that I could afford, and that was SoFi, because I want to. SoFi is going to be the featured horse in the program, because it's the one that I could afford to wheel, and it's kind of the Goldilocks scenario, because the stock isn't really moving and I can afford to strangle the living shit out of it. So that's really the main reason that I picked SoFi. And I feel like it also offers, out of all the stocks that we've talked about, it offers potentially the fastest double once earnings come out. Like I think that SoFi, because it's been compressed for so long, it's like a spring that's loaded. I think that SoFi could legit go from like 7 to 10 really, really quickly. Right things fall in place. It could go from like 7 to maybe even to 12, 13, possibly 14, a lot faster than Palantir is going to go from like 23 to like 46, in my opinion. A lot faster than Tesla is going to go from 160 to 320. A lot faster than PayPal is going to go from 66 to 130. So this was just all calculated risks and computations and quote unquote gambles that I did in my mind. That's why I wanted everything centered around SoFi, because what's the objective? We're trying to get to $100,000 in the portfolio. So I felt like SoFi offered me the best risk reward for the portfolio right here, right now. So there's that. So what else do we have going on here? We have the SoFi $8 put. I'm monitoring that. And like, again, I don't want to take ownership of too many shares right now, because that's going to limit the things that I'm able to do. We can't afford to have too much dead money in this particular account, because then now we're kind of stuck and we can't do much. And then we also have the leaps that we bought on SoFi. Now, if SoFi keeps dragging its ass right here and it doesn't keep doing much, I can't afford to just be out this $1,445 and just hoping and praying that SoFi goes up. At some point, I'm going to have to take calculated risks and start selling covered calls against this. So I might even have to turn SoFi into a poor man covered call over here, so I can start bringing some of that 1,445 through the door if SoFi doesn't start performing right here pretty soon. Ideally, I don't want to do that until SoFi crosses over $8. That's the plan, because then I will be up probably in the neighborhood of about 15% or so, depending on how fast that happens. And then I have a little bit of a cushion if I were to get in trouble with that covered call, because then I could be like, it just really got out of hand. I'm like, screw it, just take the shares. You know what I mean? Like I'll be in a commanding situation. So there's just like a lot of tricks that I've done, because I've been doing this a lot offline that you guys haven't seen. So I'm already very, very familiar with this strategy, guys. So, I feel very, very comfortable with it. So let me check in with you guys. And then the next thing I'm going to do is I'm going to look for the poor man covered call on PayPal. That's going to be the next thing. So let me keep going here. Watching from another hotel, right on. I sold 100 covered call contracts on Monday that expire at $25.50. Right on Palantir. Right on. Good strategy. Bad stocks for the long term. You think Tesla's a bad stock for the long term? You think PayPal's a bad stock for the long term? I don't know. I disagree, but I guess that's why we all manage our own portfolios, right? Why don't you click the link and here, I'll share the link with you, Crypto Man, because you've had some things to say on my comments. So I'll click the link right here, and you're more than welcome to come on the channel. But the only thing that I ask for you to bring is your portfolio, and we can all analyze it and see how good you are, because everybody's real good on the comments, and I'm cool with that. but I want you to bring your portfolio and your results, and we can talk about your results, and we can compare them with our results over here that I've been fully transparent with, and then we can really compare apples to apples, because that's the way that we rock on this channel, because I don't like that kind of commentary if you don't bring the results. So that's just the way that it is on this channel, man. Take it or leave it, but that's the way that we rock. Like full transparency is our moat. So if you're going to come with that kind of commentary, you got to bring the results. So let's keep it rocking and rolling. Let's keep it rocking and rolling, guys. So what else do we got going on? PayPal. Let's rock with PayPal. So now we got to go find the leaps that we're comfortable buying. And then we're going to talk about why I like to rock with 70 deltas, because there's a lot of people, a lot of experienced poor man cover call folks that like to promote the 90 delta. And that's cool. Do you? I don't like to do that. It takes up too much capital. I like to get capital appreciation because I feel like that's easier for me to manage. Like, I'm only doing this on a stock if I think that the stock has some run in it. So I would rather do it at a 70 delta. It takes less capital. And then whenever the stock runs up, I'm going to make more money on that side of things. And then it's less covered calls that I have to sell against those leaps so that I can get to my break even on the premium side of things. And the big money for me is going to be made on the capital appreciation. So there's that. So there is that. So let's look at PayPal. And again, you guys, it's a lot safer if you do the 90 delta. I'm just telling y'all what I do. So you gotta do you, right? Like Mr. Premium of the Option says, we are all the CEOs of our portfolio. So I'm just telling y'all and showing y'all how I do these. I'm not saying that this is the perfect way to do them or anything. It's just the way that I've been doing them, and really, really works well for me. So I'm gonna look to do that. I'm gonna go look for PayPal, and I'm gonna see if it offers me an opportunity at about a 70 delta to see if I can buy a leaps and we can get the party started. So here's PayPal. That's not PayPal, is it? Here's PayPal. And this is a good situation here. PayPal losing today. So you go trade options, and it's real simple, guys. The first step is you buy a call. What's the sweet spot? The sweet spot's about 18 months. So why? Why is it 18 months? Because if you go way the hell over here, at some point it becomes counterproductive, because that theta decay, it just does. Like, they've done studies, guys. Like, they've done studies, and I've read like 10 articles, and I came to this conclusion that this little sweet spot, like right in here, is the sweet spot. If you just start going further out right here, it's unnecessary. Like, it just seems easier to make money if you buy your leaps right in this little sweet spot. So I'm going to pick this guy right here. That's less than 2 years. And I'm going to look for about a 70 delta. So 70 delta for me is probably going to be, either the 62.50 or it's going to be the $60. And you guys are going to see that it's less than $2,000 to control 100 shares of PayPal. And I can start collecting cover call premium on PayPal as if I've already owned 100 shares. Whereas if I want to own 100 shares of PayPal right here, right now, we got to shell out $6,562 right now. That's a lot of money for such a small account. So that's just the reason that these things are so appealing and compelling for your smaller to mid-size accounts, and even your larger accounts, because it's just a more efficient use of capital. And then also, we haven't talked about the risks and the rewards. Let's just say the stock doesn't perform, or let's say the stock goes to zero. When you own the shares, in this case, $6,500 worth, and it goes to zero, you're out $6,500. When you buy the leaps and PayPal were to go to zero, which is a very unlikely scenario, right? But I mean, that's why it says unlimited risk, right? Whenever you do this kind of thing, because it could go to zero, the only thing you lose is the premium that you paid. So your risk is a lot less, but your reward is very similar. So in actuality, to me, a poor man covered call campaign is a much better campaign than a traditional covered call campaign once you learn how to manage it properly. Again, in my opinion, the gimme and the gotcha is the when you own the shares and you do a traditional covered call campaign, your shares do not expire unless they go to zero, which is very, very unlikely with a company like PayPal that's buying back the float. So we know PayPal is not going to go to zero, right? So there's that. Here, the lease is going to expire. That's the thing. But it's also in a situation, if we do it at like 60 or 62.50, to where we could potentially take ownership of these shares and turn them into shares that don't expire, sell a few rounds of covered calls against those. If we haven't totally finished collecting all of the premium that we laid out, we still think that PayPal has some legs, etc. We just want to max out our potential, and then we can get rid of the shares down the road for even a nicer profit. I mean, there's so many options that you have, but you didn't have to tie up all of your money right here, right now. So I just think that the poor man covered call, and I've been studying this thing going on 4 years now. I'm absolutely convinced that you don't have to own shares. Like, you could just do this unless it's a dividend paying stock. Because if it's a dividend paying stock and you're running a poor man covered call campaign, you're not qualified for the divvy. So I just gave y'all a mouthful that I'm going to say it very, very slowly for you guys. Is, again, this is for a more advanced wheelers, right? Wait for the book. That's Wheeling 101. This is Wheeling 201 now, right? We've already graduated from elementary to junior high school. So we're now going junior high school to high school level now. To me, it is more capital efficient if the stock is not a dividend paying stock. And in lieu of owning shares, like I would own half shares, and then the other half, I would rather have leaps and sell covered calls against those leaps, because that's more capital efficient and you have a very similar reward profile, but you are minimizing your drawdown. So you're minimizing your downside while maximizing your upside, and that's the riddle that we're always trying to solve. So there's that. So let me keep going here. Stevie P, I made a live broadcast. Not sure how we get off of NEO unless we are willing to hold till 2026. At these levels, I think there's going to be a bump. I think there'll be a bump. They'll have a good deliveries report or something with battery swap. We only needed a bump like $1. You know what I'm saying? Like, that's reality. We only needed a bump like $1. So I think that there'll definitely be an opportunity, or we got to just sell 3 or 4 or 5 rounds of covered calls. And then at that point, with the adjusted cost basis, yeah, we might lose money on the actual shares, but all in all, we could just lose a little bit of money on the overall position or break even, and we can get out of there. It just, again, depends on your objective. And again, I don't know your situation, Stevie P. Like, I don't know how deep you are in NEO. I'm not recommending anybody sell the shares for less than they paid for them or anything of the sort. I'm just telling y'all what my goals are here. Is I want to have SoFi, Palantir, Tesla, like, to do regular wheeling, if you will, sell put, sell cost, collect premium. And then I'm doing the poor man cover call campaign on PayPal and Tesla, because I can't afford to wheel them in this account, but I still want to participate with a higher quality company, higher quality stock, so that my portfolio looks a lot more robust. Because oftentimes you see a small account and you generally have shitty holdings. I want to have a small account with pretty solid holdings. In my mind, like for me, in my mind, these would be solid holdings. Like SoFi, PayPal, Tesla, Palantir, pretty solid portfolio. Again, my opinion, right? I'm the CEO of this portfolio. So whatever your 4 horses, 5 horses are, 10 horses are, you got to be proud of those. It's like you're meeting with the board, right? Like I saw a little episode of Bob, and I could relate to that, because I have to meet with investors on a regular basis, and I have to defend the positions and the moves that I made. And I got to be real proud of what I did. And I got to give them, like, okay, this is what happened, and I think this is what's going to happen. And I got to defend everything, and I got to get really, really excited about it, etc. So if I've got SoFi, PayPal, Tesla, and Palantir, I just feel like this portfolio is going to go from 25 to 50 in like a year, pretty confidently. And then after that, it's going to go from 50 to 100 a year after that, pretty confidently. So that's just me. That's just me. You got to defend that covered call. We're going to talk about it. Guys. It's going to take us several episodes to get real comfortable. Again, I don't recommend you guys following me in to any of this stuff, like stay in your lane, sell puts, sell calls, collect premium. I'm just trying to show some diversity in the channel and show you that if you want to play with a more expensive stock, but you have a limited bankroll, there are alternatives out there. This gives you an opportunity to participate with a higher dollar stock with less funds, because we can all agree that, let me just get to it right here, because I want to find the trade. I think it's going to be right here. Yeah, it says 72 Delta. So I'll rock with it right here, $60. So what am I saying here for $60? Let's talk about it. So essentially what I'm saying is I'm willing to buy PayPal at $60 on or before January the 16th of 2026. And I'm paying essentially $2,000 for that right. It's not an obligation. It's a right. There's a real big difference when you're buying an option versus when you're selling an option. When you're selling an option, you have the obligation to do so. Whenever you're buying the option, you just have the right. You control the right to exercise, but nobody's going to force your hand unless you do nothing by a certain time. Then they'll automatically exercise you. And we'll talk about all of this stuff as we go, guys. So what I want to do is I want to go ahead and put this in play. And I want to see if I can get it done right at like 1970, because the less we pay, the better it is, right, for us. So I want to do it like something like that, like right in the kind of like in the middle, but I want to get it filled. Like I ain't screwing around. I'm going to be like, I want it in 1952 or whatever. Like I want to get this done. So essentially what it's saying here is you're paying $1,970 for the right to buy 100 shares of PayPal for $60 per share by January the 16th, 2026. If PayPal shares aren't $60 or higher on January the 16th, 2026, this option will expire worthless. You're also paying regulatory fees of $3 per contract. So there's that. So there is that. And I've got $9,000 available. So this is much more economical, guys, than just buying the shares outright or tying up all of my buying power to sell a cash secured put. Because let's take this trade off the table right now. And let's just say I just wanted to sell a regular old cash secured put on PayPal. And I go over here and try to do that. You guys are going to see that my account's just not really big enough to do that. I wouldn't be able to do much else. Let's just say I wanted to do my regular 30 to 45 days out, because that's what I do. That's what I've been trained to do. And I'm like, okay, well, I think PayPal at like $63, that's probably going to be about a 30 delta. Like, I just want to rock with it right there. And let me just make $40, $140, because I'm the casino. I'm not the gambler, all of those things, because I believe in all of those things wholeheartedly. Truly, I do. And all that's cool. And all of that is cool. I could essentially do that right here, right now. And instead of forking out $1,900, $2,000, I could essentially position myself to make $147 right now. Review order, and I have enough money to do it, right? Because I got $9,900 available, and I can essentially tie up $6,300 in collateral to make $147 right now. That's a regular cash secured put. But look at how much money I'm having to tie up to make that kind of money. Whereas in this other scenario, I could just fork out, let's just call it 2,000, and then I can turn around and pretend that I already own these shares and I want to sell a covered call 35 days out, and I want to do it at something very, very safe at, like, say, I don't know, $73. With that $2,000, I can bring in, because that's going to be an 18 delta. That's going to be pretty safe. I could bring in $66 right now. So that's a much higher ROI. If you're forking out $2,000 and you're bringing in 66 versus tying up, 6,300 bucks to bring in 140 bucks. You know what I mean? So you can see that this is just a lot more capital efficient, and you can make a lot more money, and then you just manage this covered call if it gets challenged. But you got to also keep in mind, if it gets challenged, people get freaked out, but it's not really the end of the world, because you know what's printing money is the long call that you bought. That's printing money if this cover call is getting challenged. So it's not like all things are lost, guys. It's not the end of the world if your cover call is getting challenged. It just means that you're making money. Now, if it gets super challenged, where you're going to leave a lot of money on the table, those are the gimmies and the gotchas, no different than a regular traditional cover call campaign. So keep all of those things in mind. So anyway, hopefully that's giving you guys a real good scope of everything. I'm going to go ahead and put this on, because I don't want to lose this trade, and we're going to go from there. I think it was at 60. So there's that. Did I get this right? 160. Hold on. Let me start from scratch here, guys. So PayPal trade options. I want to buy a call for January of 2026. This is where I want to rock. And I was going to do it yesterday, guys, but it would have been 666 days. So that's why I couldn't do it yesterday, because I just couldn't do it, because it was 666. Come on, who wants to do that, right? So just so y'all know why I didn't do this yesterday, because I thought about doing it yesterday, but whenever I saw the days to expiration, I was like, there's no way that I could do that trade yesterday. So anyway, just so y'all know, that's the reason I didn't do it yesterday. So 72 delta, I'm ready to rock and roll with that one. 42 volatility, that's good. Whenever you're buying options, you want your volatility to be pretty low. Whenever you're selling options, you want your implied volatility to be very, very high, because that means you're collecting premium. Whenever you're the one paying premium, you want everything's opposite. You want everything to be lower, because you don't want to shell out as much money. So we're going to go ahead and click this little box right here. And the first thing we're going to do is we're just going to buy the call. So that's the very first thing we're going to do. And we're going to try to get this filled. Now we might be able to get a better price. I wonder if we can get it filled right here. We'll try to get it filled right here. So we're paying $1,955 for the right to buy 100 shares of PayPal at 60. And let's see if we can get it done. So it's placed. So the bid and ask is 1955. So I don't think it's going to happen. I think we're going to have to go at it like 1965 or 1970, which is where I think it's going to happen. But we'll let it stew for just a little bit, and let me check in on the comments, and we'll go from there. Let me check in with you guys here on the comments, and we'll see what happens with this particular one right here. Let me look at the bid and the ask. Yeah, there's no way that that's going to happen. So I'm going to have to put that at like 1965, 1967 to have a chance, but we'll let it stew here for just a second.